Hey, good morning, everybody. It's Mike Shea, Transworld again. And this morning I've got Michael Hershaft from Celtic Bank. I've known Mike for 15, 16 years in a lending relationship. Good guy. So I wanted to get him on to give everybody out there that's transitioning, both buyers and sellers, an understanding of how the SBA works, who actually lends the money, because everyone thinks it's the government, and it's not. It's the banks. So Mike's going to give you a little bit about 7A, 504, and then the SBA lending in light of COVID. So with Mike, go ahead and run with it, and then I'll interject some questions if I got some.
Sure. Thanks for having me, Mike. Appreciate it. Yeah, I'll address the elephant in the room. I am a Star Wars fan, so just any comments, that's fine.
The force be with you. Yeah.
Yeah, especially now during this time with banking and lending. But so a lot of people know that there's two predominant programs with the SBA, the 7A and the 504 loans. 504 lending is predominantly for real estate purchases and real estate refinance. 7A, you can do, I don't want to say just about anything, but just about anything. So you could do business acquisitions with or without real estate. You could do debt refinance. You could do real estate purchases. You could do expansion. You could buy inventory, equipment, working capital, etc. So the key differences between both is 504 is for mostly real estate and equipment, and 7A is basically everything. So if there's going to be an undersecured piece of a loan, the 7A is going to be a better product. But if it's just a straight real estate purchase or refi, the 504 is probably a better product.
So when you say unsecured, what does that mean to the non-banking familiar person?
Great question. So for a business acquisition, for example, so let's say someone's buying a pizzeria, and let's say the pizzeria is on lease space. Well, there's no real collateral other than the equipment, the ovens, the sinks, the freezers, whatever. So that's really the only thing that holds collateral value. Well, let's say that pizzeria is being sold for $500,000. Well, that price is probably being justified based off historical cash flow and not as much the collateral asset value. So let's say the collateral asset value, the ovens, the freezers, everything, let's say that works out to be, $100,000 or even $150,000. Well, there's still a $350,000 or $400,000 collateral shortfall. So with an SBA 7A loan, because the bank is guaranteed by the government, the 75% of the loan is guaranteed by the SBA. So that's where there's a collateral shortfall, and that's what you could use a 7A loan for. You cannot use a 504 loan for that scenario.
Right. And I think sellers need to understand if they buy all this equipment, they build out a restaurant, the purchase value and what they invest has little to do with what the collateral is for a buyer. It's because the bank in essence doesn't want a bunch of pizza ovens. It's not like a house that holds value in the marketplace. This is a discounted, liquidated, value, and that's how the banks look at it from a collateral standpoint.
That's correct. And one of the biggest things that we look for as SBA lenders is cash flow, historical cash flow. The bank's position is, hey, if there's going to be a collateral shortfall, well, what's the mitigant? And it's going to be historical cash flow. So there's oftentimes I'll get, when I go to pre-qualify listing for a broker, sometimes it's a very asset-heavy business. Well, if the business is being priced too much on the value of the assets and not as much the cash flow, that's where sometimes from the lending perspective, it becomes a little more difficult because, to your point, cash flow is what repays the loan, not equipment. Right. So we as SBA lenders, we would actually prefer to see cash flow as opposed to a lot of collateral in a business acquisition scenario. And then every lender is going to be a little different as far as what their own credit appetite is, as far as how much undersecured they're willing to go. There are some lenders who will go $5 million undersecured, and then there are some lenders who will go zero undersecured, meaning that there has to be collateral dollar for dollar based on the loan. So that's lender specific.
So let me translate that. One of the common problems we encounter with sellers is that sellers wait till, maybe they talk to a broker when they're a year out from retirement, they played games or not, had as healthy a cash flow, draw whatever conclusion you want as to why, and then all of a sudden they have a high performance. That 1 year doesn't necessarily look good in the eyes of the bank because they've either not reported cash or they play a game with their inventory and soften the reported cash flow. So when a bank looks at a deal, we want to see 3 to 5 years of solid performance historically, right?
3 is exceptional. I would say if you could get, two tax returns, and as long as the trends are they're kind of growing like this, we don't want it like this. Like 2018 tax return, you have 0 cash flow, and then 2019 it cash flows all day long. So that's considered a hockey stick deal. And the other issue you run into that with that scenario is from a business valuation standpoint. So the business valuations that are generally done, that's accepted by banks, SBA lenders, they're basing it off a discounted weighted average off the last 3 years of historical cash flow. So with the most weight being applied to the most recent year end. So obviously 2019, if the cash flow is strong, it will get the most weight, but know that 17 and 18 18 is going to get, a good amount of weight. 17 is going to drop off a little bit. So, any sellers listening, the SBA and the IRS are cousins. So SBA lenders, we can lend on goodwill. We can lend on enterprise value. We can lend on blue sky. But you kind of have to show the cash flow. So sometimes it's okay to pay your taxes. You really can't get paid twice all the time. So I would recommend.
You can't beat Uncle Sam twice. So
yeah. So I would say, to your point, if you could consult with a broker like Mike, if you're going to be selling within 3 years, you want to start basically pay your taxes and show as much as you can, because it's only going to increase the value of your company.
Right. Now, you made a comment like, oh my God, if I had 3 to 5, that's exceptional. The point is that the sellers need to understand, and this is kind of apart from SBA lending, that when you have clean books and when you're bankable, meaning the SBA is going to look at it and say, I can do this deal all day long, the deal itself becomes more competitive in the marketplace. From a brokerage standpoint, a competitive environment. I mean, you look at deals every day and it's like 9 times out of 10, you can't finance it, as do I. Once it becomes bankable, the competition for the deal becomes greater. The seller gets a premium. Simple.
Absolutely. Yeah. Absolutely true. So I would think it becomes a premium, not only from if a buyer is going to need a loan, but even from the buyers. So it's going to, I would imagine, again, I'm not on the brokerage side, but I would imagine it reduces the amount of negotiating price, because if it's got solid books and records for 3 to 5 years, I mean that's pretty hard to contest. So
well, you and I were looking at the deal the toy business last year, and as soon as they fell to the right price point that we had said it would go at, 6 offers, and then the bidding war began, and literally the buyers bid each other out to the ceiling, and it was cash deal done, right? And at that point it was like, it wasn't up to me. It was like, you all need to compete. I mean, I got some heat, but I'm like, the seller in that circumstance planned in advance, did the right thing, had proper CPA support to mitigate taxes where they could, but had a clean set of books and consistency over time that allowed it to grow. And then,
correct.
When it went to market, it was good to go.
And I could tell you from a lending standpoint, I love when I see the financials, the trend being good and the cash flow. Like I said, if I get 3 years of debt service on 3 tax returns and an interim, man, it's really usually a very good deal. And especially if it's cash flowing over 1.25 times.
So you might want to explain to the layman what the cash flow number means.
Yeah.
What does that mean? So we say cash flow, there are certain things on a financial statement that are acceptable to the banks and certain things that are not.
Right. So speaking specifically from a lending standpoint, and I'm going to speak specifically from Celtic's point of view, because every lender may accept different add backs or different items to cash flow and how they calculate it. So I'm going to speak specifically about Celtic and in general. I mean, I've been doing this for 16 years and I've worked at different organizations. So Celtic's point of view is not really that far different from most lenders. But so the first and foremost, the net income, believe it or not, most lenders are going to take the net income from net income per books, which is page 5 of the tax return. It's the retained earnings reconciliation. So we're not taking the net income from page 1 of the tax return. Typically, though, the net income per books will tie into the page 1 net income, especially if there is a section 179 expense. So that's part of depreciation. And we at Celtic, we do add that back. So from a net, we take the net income per books, which is page 5 of the tax return. Then if there's section 179 expense, which again is related to depreciation, we add that back as well. Other items that we take as add backs, obviously interest expense, depreciation, amortization, seller salary that's going to go away. Any employees or family members that are getting paid from the business that either A, don't work there, or B, they're not needed by the buyer, we can add those back. We also, though, we have to factor in a new buyer's salary, though. And this is one step, again, that a lot of brokers forget when they're valuating a business. There's a lot of times where brokers will send me, they want a pre-qual, and they have a price of a business a little high. And when I see their valuation and their cash flow calculation, I notice they're not putting a fair market replacement salary in for a buyer. And that's needed for 2 reasons. The first reason is the business valuation companies are going to put one in. So, they're going to factor based on the industry and revenue. They're going to say, this type of business commands a salary of X. And they're going to hit the cash flow for that. The other reason is every bank has a personal debt service requirement for their buyers based on their personal debt. So, so if someone, we use a 50% debt to income ratio. So it's real easy for us to figure out. So I always figure out, what does this buyer need to take? You could take 2 buyers of the exact business. Let's say everything is equal, experience is equal, everything's equal, but one buyer is heavily leveraged and the other one's not leveraged as much. Just because one buyer needs a salary double the amount compared to the other buyer doesn't mean it's not a good business, or doesn't mean the business doesn't valuate out. It will valuate out. The business value doesn't go by the buyer just because of their required draw. Some other add backs that we typically don't take, we're not taking.
There, Mike, let me stop you there. The buyers need to understand that the banks are going to look at the debt on their books. So if they got a 10,000-foot house and a $10,000 a month mortgage, and they pop over the ratio of what the business can provide, and the comfort level of the bank for what I always call the ratio is that comfort buffer, because the bank wants to look for, if something like COVID happens, what's the risk that the bank gets? So the buyers need to understand, and the sellers need to understand, there's the bank, there's the buyer, there's the seller, there's the appraiser, and then there's the SBA requirements. There's all these extra fingers in the pie to get the deal done. That's what makes it so damn, complicated. So when we talk to buyers, to sellers, it doesn't matter whether you cash flow. It's who we can get through the process to borrow the money. So on a $2 million deal, $3 million deal, the guy's got to meet muster. If he pulls up in a Ferrari, I get nervous. I'm like, well, that means he's probably borrowed money to drive that damn thing. That's going to add on the burden to get him through the process, right?
It's very true, because we're doing a global debt service. So again, the more debt the buyer has, more of a salary they have to take from the business they're buying, unless they have other sources of outside income that could cover it. So some buyers are able to keep their existing job or buy a business. So we'll use their existing job income to offset it. But if it's not that scenario, and a buyer is buying a business and that business they're buying is becoming their primary and only source of income, then yeah, there has to be enough cash flow in the business to not only support their personal debt, but pay the SBA loan as well. So right. It's a really good point. And then from an add back standpoint, cash transactions that's not reported on a tax return, we can't accept.
Because
Gas,
the SBA is the stepsister of the IRS.
yeah, of the IRS. I mean, they're cousins. So gas, tolls, maintenance, mileage, sometimes very difficult. Having said that, though, I've had people who own boats and airplanes, and they've had payments for their boats and airplanes. That's an acceptable add back because you could document it really easy, and it's not very subjective. So the more subjective of an add back, and honestly, if I need $500 add back to make a deal work, we're probably not going to do the deal.
Right.
So yeah, those are the typical add backs that most lenders are going to use.
Okay. Yeah, I always encounter it where there's this confusion, and part of the purpose of this video is to give some real clarity to everybody. So it's not me saying it's like, look, this. And by the way, it really doesn't matter what bank. And I'll get into, look, the rules of the SBA are the rules of the SBA. There's some minor differences, but the balance sheet of the bank somewhat dictates what they'll do and what they won't do, because they're a third party to this loan. They have to make money. So there are banks that won't lend on restaurants. I get it, right? There are businesses that they, bars, there are liquor stores, there are certain things they view as risky for whatever reason, because that loan is 10 years. So they're looking out, hey, what's the viability? What's the buyer look like? What's the industry look like? What's the seller look like? There's a lot of moving parts to get to. That's why they're so hard to do. And that's why who you pick as a BDO is real important. Like, I have like certain rules when I go to banks. It's like, I really don't care about the bank. I care about who the BDO is, and does the BDO have a relationship with the underwriters? And like, can you pick up the phone and talk to people and explain the industry? Because if they're looking at a business in Florida, and there's certain businesses in Florida that are unique to Florida, do they understand what we do? Or is this a 30-year-old kid with an MBA in a cubicle who's just out of college who doesn't know, what vacation rentals are, right?
Right. Yeah. I mean, I don't know if it's to my detriment or not, but I'm brutally honest with the brokers I work with and my borrowers. I'm not the most aggressive lender out there, because when I'm looking at a deal or structuring a deal, I'm doing it based on how we could get it approved. You could take the same deal, same buyer, same seller. You could go to another lender, and even if I say no, another lender could say yes. Mm-hmm. So when I'm structuring the deal, I'm doing it based on how Celtic is going to like the deal. That doesn't mean that it's not a bankable deal, because to your point, every lender's different. There are some really aggressive lenders out there who will do more.
And I would say for a period of time. So, you and I both know there's a bank that for the last 6 years has been super aggressive. And I always giggle. It's like, you ride that horse till it bucks.
Right.
It bucks because then they write bad deals. Their balance sheet goes to crap. And God forbid you as a borrower need to renegotiate or get a second loan and their terms have changed. You're kind of a victim of it. So in any vendor relationship, a borrower needs to look at the health of the company that they're borrowing from. All too often, it's only self-respective because they're thinking in the now and not what the deal looks like in 5, 6, 7 years. That forecasting of what the environment will look like. So yeah,
correct.
I tend to discourage people from looking at the big banks because they tend to have real estate heavy portfolios, and those things ebb and flow in a 10-year cycle. And if your loan is starting in year 5 of their 10-year cycle and you get caught with your pants around your ankles in year 5 and you need to renegotiate and they're holding you by the huevos, you're stuck. There ain't nothing you can do because he who writes the check makes the rules. So that's always a challenge. And what's one of the things I want this video to do is for buyers to understand when they borrow, they need to think a little bit longer term about who they're partnering with and will they be standing and what will their business look like in 10 years.
Right. The other thing is, every BDO or lender, they work a little differently. So I sleep well at night because I know I'm honest. So if I like a deal and I've got it structured the way I believe Celtic's going to approve it and close it, it's accurate. I know there's and there's a lot of SBA lenders out there now, and there's some really good ones. There's a lot of good ones. But there's, unfortunately, because SBA lending has grown so much, there's a lot of inexperienced lenders. And if they don't know what they're doing, sometimes buyers are immediately attracted to, hey, but this guy is, a half a point less or whatever.
Yeah.
And I say, just go for it. If it works out for you guys, good luck. A lot of times I get a call back though in about a month or two, and they're like, I got to get this closed as soon as possible. I'm like, well, what happened with the other thing? Well, he couldn't get it approved. And I kind of knew he wasn't going to get it, or they weren't going to get it approved, because the structure they were promoting, it just didn't make sense.
Right. And what the buyers don't understand, or the borrowers don't understand, is when they're talking to a BDO, that goes to my comment earlier, is it's the person writing the loan at that big mega bank in your banking center in your local neighborhood is just filling out paperwork. They have no relationship with the underwriting team, and they're just kicking it up and taking the fees on the front end, with the best intent often, but they don't know the industry or how lending works, or what does the balance sheet or the context of what our balance sheet looks like in the risk portfolio in the current economic environment, and is this thing going to fly? So, when I put lenders in front of people, I beg the buyers, please pick one of these 3 or 4 because of that. And second, you're going to tell me, because the last thing I want to do is go 60 days into a deal, piss off a buyer and a seller, because then the goodwill goes to shit. Excuse my language. That's what happens. Right. And then the deal whole craters. And who the BDO is incredibly important, because you and I both know there's a lot of hand holding and a lot of navigating. Just because you get approved for a loan, that's just the beginning. That's
right.
Just the beginning.
Yeah. Like when I'm structuring a loan, I'm figuring out what's it going to take to get it approved, but I'm also thinking about the closing side. I'm not a closer, but I know enough about it to what's it going to take to get the loan to the finish line. So I'm thinking about different things after approval to make sure that the loan can close, just because you could deliver an approval, but it doesn't always translate to a closing. So, so I try to think about stuff like that and address it.
It's often hard to get borrowers to understand everything that goes on. Once the approval's done, they get all excited, like, hey, this is good to go. And, I'll look at them and go, okay, you don't do anything without talking to me, right? And then you and I are always, you and me or the other BDOs we work with are always in this like, all right, he said X. Did he say X to you? We're confirming, because their understanding of the context of their words or the actions that they take doesn't necessarily reconcile to what the outcome is that they desire. So the borrowers have to really trust their BDO, communicate with their BDO, communicate with their broker and their attorney, and all 4 got to be on the same sheet of music, marching lockstep. And then one of them has to kind of be running herd over everybody, so no one's going off the radar screen, including family members.
Yeah,
wife doesn't go buy a car, right?
Yep, it's paramount. I can't tell you how many times buyers will call me while a deal's either about to go to underwriting or we're in closing. I always tell them, listen, before you do, if you're going to buy anything more than $1,000, you need to talk to me. Or if it's going to cost more than $1,000, we need to talk. Because sometimes they want to go buy a house, or they want to go buy a car, or they want to do something. And so I have to look at the numbers to say, okay, if you do this now, you're going to have to disclose it. It's going to go back to underwriting, and it may have an effect on the deal. Or I'll look at it and say, that's really not going to make a big deal. Or it changes the collateral too. So,
which could change the terms of the deal and piss off the seller, and the deal could crater.
Correct. Yeah. So that's an incredibly important point, is that I can't stress that enough, that buyers need to communicate with you or brokers and lenders as much as possible throughout the whole process. And honestly, if they're going to buy anything more than $1,000 or spend it, then it's really have the conversation.
Yeah, and one more point about that communication is, and one of the reasons I have Mike, or I've worked with Mike so often, is my second demand of bankers is I have your cell phone, and I respect it. And I'm not going to bother you, but if I need to talk to you, I need to talk to you, because come 5 o'clock on a Friday, life doesn't stop. You know, we operate in different time zones. Buyers may be coming from California. Celtic's headquarters is in Utah. Mike's in Florida. We need to be able to communicate at all times. And, oh, it's Monday through Friday, 9 to 5. No, not in this world. It's not. It's 24/7. I mean, we respect it, but there are times when I've had to call Mike on Christmas Eve at 6 o'clock in the evening and go, hey, this happened. And, and fight through whatever the problem is to get it done. And sometimes, the buyers, because these tend to be larger deals, so the buyers tend to be kind of strong-willed individuals. It gets emotional. And by that, I mean, sometimes they're yelling at me or calling me every name in the book or saying I'm an idiot or whatever, thick skin. The objective is to get the deal done. And then afterwards, like, I didn't know how hard it would be. I didn't know, you guys would be kicking me through this process to get me to move. And it's hard because you're used to being like this strong individual, and then you got these people you've just known for 3-4 months, controlling your life as you move through it. That's a hard dichotomy to operate in.
I had a deal close recently where the buyer was, during the closing process, the buyer was, I don't want to say becoming difficult, but he was making just some demands on the seller, and I stopped the buyer and I said, now, I just want you to listen to what I'm going to say. I said, I've been doing this for a long time. I have some experience with it, just some food for thought. I said, after you buy this business and after you're done with your contract period of the training, if you and the seller don't have a good relationship and you need that seller for something that's going to come up after your training period,
it will come up.
Which it most likely will come up. The seller could tell you to go pound sand.
Yep.
Whereas if you have a good relationship, you guys are amicable, after that relationship's inherently people want to help people. I would assume that, a seller is more willing to help. So the one thing I always stress is have as good a relationship as you can with a seller, because you have no idea when you're going to need them. Yeah. Because there's going to come that point. The other thing I always tell them is, yes, this is a pretty emotional time for you, because for buyers it is. It's pretty life-changing. They're buying a company. Sometimes it's their first company they've owned. They're making a career change. Sometimes they're moving. So they have some moving parts. But I also remind them, I say, you have to understand, this is emotional for you, but this is also emotional for the seller. How long has this seller owned this company? This has been the seller's bread and butter for how many years? This is potentially their baby, and now they're not going to have it anymore. So yeah, you're going through this, and I'm not discounting that because there's a lot of things happening on your side, but you have to remember the seller too. It's going through their mind. It's definitely an emotional roller coaster for both parties.
Yeah, on goodwill businesses, to your point, you're going to call and ask for help. They may not choose to, but they don't have to do anything after the contractual, requirements are there, and that speaks volumes. So, most people's experience with negotiation is something, leverage, because there's an asset being purchased, a car or a house, right? And this is air. This is blue sky. This is goodwill, and this is reputation being transferred. And you can put all the stuff you want on paper, and I know the lawyers are going to watch this. Or you're like, this isn't true, but I don't have to do anything. I can just be idly quiet after my obligations are done and not be an advocate. And advocacy for the business is as important as the contractual components of it. And lenders do look at difficult buyers and go, this guy's going to crater it. If you don't have that soft touch, then lenders will go, I'm not sure you're the guy I think can run this business.
Well, and that's one thing that, speaking specifically of Celtic, our underwriters interview every single borrower. So they got on a phone and talked to every single borrower. And our approach, though, is we make the conversation pretty general. Our underwriters and the bank's philosophy is not to, hey, let's see what question I could get him on, or let's see where I can make him screw up and, he didn't really do this. No, I mean, we give a very general conversation, which I appreciate and buyers appreciate because it takes a lot of stress off them. because sometimes buyers are pretty stressed out when they know they have to talk to an underwriter, but I'm always on the phone with them as well. So it'd be myself, the underwriter, and the borrower. But you're right. If the underwriter, if the buyer just sounds like an idiot, but quite honestly, if a buyer does sound that wrong,
something else is already wrong.
well, I might explain to the broker and say, listen, this buyer, or I'll even have a candid conversation with the buyer, and I'll tell them, listen, with them, you can't sound like that. You're going to make this more difficult on yourself than not.
Yeah.
So yeah, it's true. But yeah, every lender's different with that. We interview our borrowers.
Yeah. And it's important because they want you to succeed. They're in bed with you for 10 years.
Correct.
Right.
Yep. The other thing, Mike, that I'm glad you brought that up is the one thing that we look at, and again, this is a Celtic thing, but a lot of lenders do this. When we're looking at a buyer, we like to see that buyers have what's called personal post-close liquidity. So even though we could structure in some working capital into a loan, we still like to see after a buyer's down payment that they're not using everything they have to get into something, because let's say COVID happens, or who knows what, let's say you have a slow month or two, or whatever, who knows. Can they weather a little bit of a storm? And COVID's an anomaly, though. I mean, there's a lot of really good businesses and good businesses owners that, this is just killing them. So, but putting those aside, just normal hiccups that a business may have, sometimes if someone, doesn't have the money afterwards, or they've gone through the working capital and they don't have a fallback position, sometimes it puts buyers in a pretty sticky situation sometimes. So
like hurricanes. I mean, you guys will look at and say, okay, hurricanes are a real anomaly. Do you have the reserves to, what does your business look like in a hurricane, post a hurricane, ramp up recovery, and
yeah, I mean,
are you safe to operate and continue to march, right?
Even sometimes with construction, if they're doing road work outside a plaza or something, and sometimes cars don't want to go into that plaza because they find it more of a headache because you got to navigate through cones.
Yeah,
sometimes it's a little bit of a deterrent. So who knows?
That's a good segue. So let's talk about the elephant in the room besides your Star Wars figures, COVID. What's the world like with SBA lending? What can we expect?
So I can only speak for Celtic, because every lender is going to be different on this. So we are processing PPP loans, and we have a separate department that does it. So like I don't do anything with PPP loans. So I could send out a link to someone, they could fill out the information, and it goes to our back office. But so like, thank goodness they don't have me processing these things. I know there are some SBA lenders who do what I do, who are actually processing these loans. The other thing is, there are some lenders who have basically curtailed regular lending, whether it's conventional or SBA or whatever, while this is going on. And they're doing it for one of two reasons: either A, because they're working on so many PPP loans, they don't have the capacity to do it, or B, they're just not sure what the overall economic environment's going to look like after this, or as everything starts to open. So we're still looking at everything. There's nothing that we're not looking at. But to be candid, if you're doing a restaurant or buying a restaurant, how does the restaurant perform during COVID? Is it doing takeout, or is it fully shut down? So every industry is going to be looked at probably a little tougher, but it doesn't mean that you can't do the deal. So I think every industry and how these businesses are coping with it or dealing with it, it's going to be independent. Having said that, though, if a business, like our stance is, if a business is currently closed down, like doors shut, they're not doing anything, we're going to have a hard time with that one right now. So we're probably going to want to see that business reopen, show that it's gone back to what it did pre-COVID or close to it. And so we could say, okay, there was the blip, it makes sense.
So is there like a timeline, like, okay, say we open up May 1 or May 30, right? Are we going to look at, I mean, then that business runs for 90 days and it's ramping up and it's back on track for the debt service requirements we talked about earlier. Then we're going to look at the COVID anomaly and go, okay, let's throw that out the window.
Right. Yeah. I mean, I think that's how a bank's gonna, or how we're gonna want to look at it, and probably banks in general are gonna want to look at it. Then it comes to business valuation. So I think as soon as the business stabilizes to its pre-COVID numbers, the sooner the better, because I did correspond with a company that does business valuations, and I think I shared some information with you.
Yeah.
They are going to take it into consideration because, again, it is based off the historical cash flow. So I think the quicker the business could get up to the pre-COVID revenue and cash flow, the sooner the better. And some businesses are going to get there a lot faster than others.
Well, the business owners who through COVID have maintained contact and are doing whatever they can to generate revenue and maybe created incremental revenue through a really pushed, say it was a restaurant, we really pushed our delivery model and seen a 15%. That's going to get sticky. Those customers will be sticky, but you got to bring back what was, right?
Right.
To the ratios required for the purchase price. Now, if your purchase price changes, then you may fall within that ratio. So,
correct.
A lot of people go into the SBA loan and they go, oh, I just got to go A, B, C, D. And I'm like, no, if A shifts from A to B, right, or backwards and forwards, right, then the ratios and the whole dynamic changes. And, in your industry and again, the 10-year forward thinking, what's it going to look like? All those variables go into the decision-making process of the bank. So what a business owner should do right now is you need to be operating whatever way you can to generate revenue, no matter what, because the mountain you climb when the lift is put in place is going to be just that much harder and higher because everybody's back at that point. And there's your competitive environment, and everybody's going to be fighting for, market share and revenue. And subsequently, the time and place it takes you to get to a point of profitability will be different, right?
Correct.
Yeah. Okay.
Yeah. So, yeah, I mean, so we're just looking at every deal, but I'm trying to get like 4 new loans submitted into credit this week because whether it's a real estate purchase, a refinance, I'm working on a business acquisition, I'm working on a startup. So there's deals out there. It just depends on the deal.
You think the borrowers should be like, look, if you found a business and it's thriving, you shouldn't wait till June 1. You should be submitting your application now.
Yeah. If the business is doing well now, why wait? I mean, it would have gone down, or you would have seen the slowdown if it's.
Well, it's funny. I have a couple lenders, a couple buyers who have said, well, who shop banks, right, based upon half point, quarter point, and then they go out there and this guy, well, we're not doing anything till June 1, and they take that as gospel. And I'm going, no, you need to get your banker, submit your application, be in the queue, because when the thing lifts, you're just going to be retarded with regard to how much time, because there's going to be an influx of people into the market, and it's going to be that much slower for you to go. And you may lose your competitive position with the seller because the seller doesn't want to wait.
Right. I closed the deal towards the end of March, and I'm not going to lie, credit and closing said they literally looked at every deal in closing and said, okay, what do we kind of want to delay a little bit, and for just reason. I mean, they have to do it. And the business that I did was a low voltage electrical contractor, and their pipeline, they didn't stop.
Yeah, the trades are on an upward swing.
Yeah, the one that I'm trying to get submitted this week, they do they're a coatings business, like weatherproofing coating.
Yeah.
You're going to need that whether you're in a pandemic or not, because it's essential. I mean, if your building is cracking and you got leaks, and you got to take care of it regardless, right? So
the contractors, across the sectors, because we're watching them, right? It's like the lawn guys are up, the HVAC guys are up, the garage door guys are up, the coating guys are up. All of the trades are just trucking along. Mm-hmm. Just drive around as a consumer, drive around and open your eyes and see who's still operating. And the
Yep.
banks do that. The banks are looking at, all right, who's good, right? Okay, these guys are good. Okay, I'll lend on that because and you're going to look at the pipeline and go, what's the what's the funnel look like? And if things remain status quo and they've done well through the, or even if they're off just a point or 3 or 4 points,
Yeah.
you're like, huh, no, it's a no-brainer.
Yeah.
Right?
And especially if it has the stronger cash flow and it's just dipped, a basis, but I mean, it's not going to be viewed heavily. It's ones that are closed or really just go down dramatically. That's where you run into the issue.
All right. Well, thanks for doing this for me. If someone wants to reach you, how do they get you?
My phone number is 407-615-0329. That's either call or text. And my email address is mhershaft@celticbank.com. MHERSHAFT@celticbank.com.
All right. Thanks, Mike. I appreciate it.